Welcome to the Deep Dive. Today, we're tackling, well, a really fascinating story from the world of finance. It's about a company called Long-Term Capital Management, LTCM for short.
Right. And even if finance isn't really your thing, stick with us.
Yeah, definitely. Because honestly, it's more than just numbers. It's a huge cautionary tale, about brilliant people, really ambitious ideas, and how things can go spectacularly wrong.
Absolutely. And we've got some great sources that let us really get into the weeds. We're going to look at how LTCM got started, what they did initially to make money, which might actually surprise you.
Okay.
Then why they changed tack, the sort of philosophy behind their investments, how the risks just piled up, maybe without them even fully seeing it, and, well, the crash.
And we'll make sure to break down the jargon, right? Explain the finance terms so everyone can follow along.
Yeah, definitely. Concepts like leverage, convergence trades, make them clear.
Okay, great. So let's start at the beginning. The main guy, the founder, was John Meriwether. Before LTCM, he was already a star trader, right? At Salomon Brothers, dealing in bonds.
Huge star. Salomon Brothers back then was, they were the bond market, practically. A powerhouse.
Right. And Meriwether was one of their top guys. Known for being sharp, making good calls.
Absolutely.
Yeah.
His reputation was top tier. He understood the nuances of bond pricing, how things traded. Incredibly valuable. That really set the stage for his credibility later.
But then things changed. He left Salomon Brothers. The sources mention a scandal, but that's not really our focus here.
No, the key point is he left, maybe not entirely on his own terms, and this top-tier trader is suddenly outside the big firm structure.
So what does he do? He starts his own shop, uses his name, his reputation, and launches Long-Term Capital Management, LTCM.
Which makes sense, right, for someone with his background. But what was really striking almost immediately was the team he pulled together.
Oh yeah, that's a big part of the story. It wasn't just other traders.
No, not at all. He brought in, academic superstars, serious brain power from finance and economics, people who were literally writing the textbooks.
Including eventual Nobel Prize winners, right? That always gets mentioned. Myron Scholes, Robert Merton.
Exactly. These guys were famous for developing theories on how to price financial options. Complex stuff. Having them on board gave LTCM this incredible aura.
Like an intellectual seal of approval.
Precisely. It suggested their strategies weren't just gut feelings from traders, but backed by, rigorous academic theory, cutting-edge models. And they set up shop in Greenwich, Connecticut.
That recruitment was key, wasn't it? It shaped their whole approach.
Totally. It embedded this deep belief that they could use sophisticated math, quantitative analysis to basically outsmart the market, find predictabilities others couldn't see.
Okay, so you've got this dream team. Wall Street experience meets Nobel-level theory. How did they actually plan to make money at first? You said it was simpler than we might think.
Yeah, initially they focused heavily on something called convergence trades. Mostly the U.S. Treasury bond market, which is generally seen as pretty safe and stable.
Convergence trades. Okay, bring that down for us. Bonds can sound intimidating.
Sure. Think of it super simply. Imagine two things that are almost identical. Maybe two Treasury bonds that mature just days apart. For various reasons, one might be trading just slightly cheaper than the other, like fractions of a cent cheaper.
Okay.
A convergence trade is basically a bet that this tiny price difference is temporary and will disappear. So LTCM would buy the cheaper one and sell the more expensive one, waiting for their prices to inevitably, or so they thought, converge, meet in the middle.
Ah, I see. They're exploiting tiny temporary imperfections in pricing between very similar assets.
Exactly. Betting that the market will correct itself.
But you said the differences were tiny, fractions of pennies. How do you make real money doing that?
Right. That's the crucial part. Leverage. Massive leverage.
Leverage. So borrowing money.
Borrowing huge amounts of money. Because the profit on any single trade was minuscule, they had to make enormous bets to generate significant returns. They'd borrow from banks, other institutions, using their own capital as a small base to control vastly larger positions.
Like putting a small down payment on a huge house.
Kind of, yeah. If the house price goes up a little, your return on that small down payment is magnified. LTCM did that with bonds. They used borrowed money to amplify those tiny expected price movements into big profits.
But that sounds risky if the price moves the wrong way.
Exactly. Leverage cuts both ways. It magnifies gains, but it magnifies losses just as powerfully, if not more so. That becomes really important later.
Okay, so tiny bets, massive scale, lots of borrowing, and initially it worked.
Oh, it worked spectacularly well in the early years. They posted really impressive returns, which just solidified their reputation as geniuses.
Built on these seemingly low-risk trades in the Treasury market.
Right. It seemed like they'd found a way to consistently grind out profits with their sophisticated models in a very liquid market.
But obviously, the story takes a turn. The outline mentions they shifted strategy. Why change something that was working so well?
Well, ironically, their own success was part of the problem.
Yeah.
As LTCM got bigger and word got out about how profitable convergence trading was.
Other people started copying them.
Exactly. More firms jumped in trying to do similar trades. And when everyone is trying to exploit the same tiny price differences, what happens?
They disappear or get even smaller.
Precisely. The competition eroded the very opportunities they were built on. Those easy pickings in the treasury market started drying up. It became much harder to make money that way.
Okay, so the well started running dry. What did they do then? They couldn't just keep posting lower returns, I imagine.
No, not with the expectations they'd set. So they had to look for new opportunities, new ways to generate those high returns. And that meant moving beyond simple treasury bond convergence.
Where did they go?
They broadened out significantly, started trading international bonds, which behaved differently. They got heavily into derivatives.
Okay, derivatives. Those sound complicated. Can you give us a simple idea?
Think of them as financial contracts whose value depends on something else, like the price of a stock, an interest rate, a currency exchange rate. They didn't own the underlying thing, just a contract related to it. It allows for complex bets.
Okay. And they also went into emerging markets.
Yes, investing in the economies and bond markets of less developed countries, places that offered potentially higher returns but were also, much less predictable and stable.
So international bonds, complex derivatives, emerging markets. That sounds like a very different risk profile compared to U.S. Treasury.
Absolutely night and day. This expansion dramatically increased the complexity of what they were doing, and crucially, it ramped up the risk.
How so? What kind of risks?
Well, these new markets were often less liquid, meaning if you hold huge positions like LTCM did, it might be hard to sell quickly without crashing the price yourself if you needed to get out.
Okay, liquidity risk. Got it.
And the price swings, the volatility in international bonds or emerging markets could be much, much wilder than in U.S. Treasuries. More unpredictable.
Right. So let's dig into that core thinking a bit more. What was the fundamental belief system driving all these decisions, even as they moved into riskier areas?
The bedrock was still this unwavering faith in their quantitative models in math. They believed that markets, while mostly efficient, still had these temporary mispricings, these little anomalies.
Glitches in the system.
Sort of, yeah. And they believed their sophisticated models, built by these brilliant academics, could identify these glitches better than anyone else across almost any market.
And those models, like Black-Scholes you mentioned earlier, were key.
They were examples of the kind of thinking, yes. Using complex formulas to understand value, predict price movements, estimate volatility, which is just how much prices jump around. They thought they could quantify risk precisely.
So find the mispricing, bet on it correcting, use math to manage the risk.
That was the idea. And another core belief was diversification.
Ah, right. Don't put all your eggs in one basket.
Exactly. They made thousands of different trades across many different markets, stocks, bonds, currencies, derivatives, all over the world. The assumption was that these trades were largely uncorrelated.
Meaning if one type of trade lost money, another type would probably make money, balancing things out.
That was the theory. They believed that by spreading their bets so widely, the overall portfolio would be stable. A loss here would be offset by a gain there.
But that assumption didn't hold up.
It proved to be a critical, fatal flaw. Because in a real crisis, a panic, correlations change. Things you thought were separate suddenly all move together, usually downwards. Diversification can vanish just when you need it most.
Okay, so they're expanding, using models they deeply trust, believing diversification protects them, but adding complexity and moving into riskier markets. How did the specific risks grow?
Well, we touched on some. Market risk definitely increased the basic risk of prices moving against you. More volatile markets mean bigger potential swings.
Makes sense.
Then liquidity risk, as we said. Harder to sell big positions in less traded markets without tanking the price, especially in a panic.
Right.
Trading complex derivatives with lots of different banks brought in counterparty risk. What if the bank on the other side of your trade goes bust or can't pay up?
Yeah. Your trade might be right, but if the other guy defaults, you still lose.
Exactly. And maybe the most insidious one, model risk. The risk that the beautiful, complex mathematical models themselves were wrong.
How could they be wrong? Weren't they built by geniuses?
They were based on historical data and assumptions about how markets usually behave. But models can struggle with extreme events, things that haven't happened before in quite the same way. Black swan events, some call them. The models might underestimate the chance of really wild swings.
So the models might work 99% of the time, but fail catastrophically in that 1% scenario.
Something like that.
Yeah.
And crucially, underlying all of this increasing risk.
Let me guess. Leverage.
Still, huge amounts of leverage. They never really dialed it back. So every risk market, liquidity, counterparty, model was magnified enormously by all that borrowed money. Small problems could become existential threats very quickly.
It really does sound like a storm gathering.
Yeah.
So what finally triggered the collapse? The outline mentions a final outcome.
The trigger, the spark that lit the fuse, was the summer of 1998, specifically the Russian financial crisis. Russia defaulted on its government debt.
Wow, okay. A whole country defaulting.
Yeah, it was a huge shock to the global system, and it caused absolute panic in financial markets worldwide. Investors just freaked out.
What did they do?
There was a massive flight to quality. Everyone wanted out of anything perceived as risky emerging market debt, complex derivatives, even some corporate bonds, and piled into the safest assets they could find, mainly U.S. Treasury bonds.
The very market LTCM started in, ironically.
Yeah. But the effect of this panic was devastating for LTCM's broader strategy. Remember those convergence trades? Betting the price gaps between similar assets would shrink. In the panic, those gaps did the exact opposite. They blew out. They widened dramatically. Riskier bonds plummeted relative to safer ones. Everything LTCM was betting against started happening all at once across many of their trades.
So their fundamental bets were just going catastrophically wrong everywhere.
Pretty much. Their models completely failed to predict this kind of simultaneous extreme divergence. And because they had so many of these bets on, all linked by this underlying market panic, the losses were staggering.
And the leverage.
The leverage turned staggering losses into an almost instantaneous wipe out of their capital. Billions of dollars vanished in days, even hours sometimes.
That's terrifying. What happened then? Did the banks they borrowed from pull the plug?
The banks got incredibly nervous, obviously. LTCM owed them vast sums. Their counterparties in trades started demanding more collateral, refusing new trades. Confidence evaporated.
So they couldn't trade their way out of it, and they were running out of money fast.
Exactly. They were facing a full-blown liquidity crisis. They couldn't meet their obligations. And here's where it got really scary for the whole system.
Why? Because LTCM was so big and connected.
Precisely. LTCM had trades with almost every major bank and investment firm globally. If LTCM failed completely, defaulted on everything, it could have triggered a chain reaction. Banks failing, credit markets freezing up, a potential meltdown of the entire global financial system.
That's systemic risk, right? The whole structure is threatened.
Textbook systemic risk. The failure of one seemingly isolated firm could cascade outwards.
So what was done? Did the government step in?
The Federal Reserve, the U.S. Central Bank, got involved, but not by bailing out LTCM directly with taxpayer money. Instead, they played coordinator. They basically locked the heads of the major Wall Street banks LTCM owed money to in a room.
And told them to figure it out.
Pretty much. The Fed facilitated, strongly encouraged these banks to collectively put up their own money, about $3.6 billion, to prop up LTCM temporarily.
Why would the banks agree to that, to save LTCM?
Not really to save LTCM as a company, but to save themselves and the system. It was an act of self-preservation. They needed to prevent a disorderly collapse that could have taken them down too. They injected capital in exchange for taking over, essentially.
So a private sector bailout orchestrated by the Fed to prevent systemic collapse. What happened to LTCM after that?
The fund was put under the control of the consortium of banks. They spent the next year or so carefully unwinding its massive, complex portfolio of trades, selling things off gradually to avoid further market disruption. Eventually, the firm was liquidated. It just ceased to exist.
Wow, what a dramatic end. From Nobel laureates and guaranteed profits to near systemic collapse and a forced bailout.
It's one of the classic stories in modern finance.
So wrapping this up, what are the big takeaways, the lessons we should really pull from this LTCM saga?
I think there are a few really key ones. First, the allure and danger of complexity. Sophisticated strategies and models can seem brilliant, but they can also hide enormous risks.
Right, complexity isn't always better.
Second, the absolute centrality of risk management. Not just quantifying risk based on the past, but really thinking about what could go wrong, even unlikely scenarios, and understanding the limits of your models.
And the limits of diversification, too, it sounds like.
Definitely. Assuming correlations will hold in a crisis is dangerous. Third, leverage is a double-edged sword, always. It can amplify success, but it guarantees disaster if things turn sour.
And finally, I guess the interconnectedness of the financial system. One big failure can threaten everyone.
Exactly. Systemic risk is real. LTCM showed just how quickly problems could spread. It's a reminder that even the smartest people with the best tools can be humbled by markets, by unexpected events, and maybe by their own hubris.
It really makes you think. So, maybe final thought for our listeners. Looking beyond finance, what lessons from LTCM's rise and fall might apply elsewhere? You know, in any field involving complex systems, big ambitions, and unavoidable risk.
That's a great question. Maybe it comes down to that balance between pushing boundaries and truly understanding the potential downsides. How do you innovate responsibly? How do you manage ambition against prudence when dealing with powerful tools or complex situations?
It's definitely food for thought. A cautionary tale indeed.